How strong is the S&P rally? Should we be worried? This is the midweek report ending April 30th, 2019. This is Agustin Hernandez. Before we begin, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on the examination of past price movements and cannot predict the future. Technical charts referenced are subjective. No strategy can ensure success or protect against loss. International markets involve special risks such as currency fluctuation and political instability. These risks are often heightened for investments in emerging markets. International investing may not be suitable for all investors. Investing involves risk, including loss of principal. Sector investing will be subject to greater volatility than investing more broadly across many sectors and companies. On this week's agenda, we look at the past week of the S&P. I will also demonstrate how the S&P looks on a weekly chart when we take out the daily moves of the market. The S&P has recovered from its losses of 2018 and now is in stage one of a potential new bullish run. But are enough stocks benefiting and should we be worried? We take a look at the new high, new low index. How has the small cap index fared? And finally, what does it mean? Here we see the daily chart of the S&P. As reported last week, the S&P closed at all-time highs, and this week the S&P was able to pass the all-time intraday high. All positive signs. The recovery took almost 5 months to complete. Thus again, I would like to emphasize, there was a lot of damage done from October to late December. As we enter stage one of a potential new bull rally, I would like to see the short-term MACD gather more strength. As we see, it has been lacking, but at a minimum, it has been positive. Any momentum that can match the late December to January rally would push this index further away from the old highs of 2018, and that would be great news. Here we take a wider and less noisy view of the S&P. In this chart, we look at the weekly chart of this index. The moving averages are just a weekly version of the 50-day and the 200-day moving averages. So, in this chart, the moving average lines are the 10-week and 40-week. I want to reiterate one thing. The drop from October to late December was steep and ugly. There was a lot of damage done. At its lowest, it shows close to a 600-point drop from peak September. And without the Fed making an about face about rate hikes, who knows how worse it could have been. So, 5 months later, in a V-shaped style recovery, we are in the beginning of a stage one bull rally. That does not mean there will be no volatility. It just means we enter a new phase, not that the recovery is complete. Positive momentum has stayed steady, and that is a great sign. For now, I am cautiously optimistic for this index. We continue with the S&P weekly chart, but now we extend it to the beginning of 2016. What I would like to demonstrate is where we are in this early attempt of a long bullish rally. To add context to where the S&P is, I added the new high-low index. This is considered a leading indicator for technical analysis. Now, what is this chart and why is it important? This index tracks the behavior of the stock market leaders by subtracting the number of new lows from the new highs. As stated already, the S&P passed its closing highs, so should we not have more strength in the new high, new low index? Should not more stocks be reaching their highs? Well, remember the S&P has barely recovered from the drop of 2018. And as we see in a new high, new low chart, we see the line drop and fall below its 40-week line in early October. And like price, it suffered. Now, since we are just in stage one of a potential bullish run, there are few sectors and stocks leading the charge. Tech is currently one of the few strong sectors. The others still need to gather strength. So the fact that a minimum this index has not crossed above its 40-week line is normal in the early stage of a bullish rally attempt. If we look at 2016, we see a very similar pattern where the S&P was generating new highs, but the new high, new low line was beginning an upward move to get across its 40-week line. Now we are currently in this area, new price highs, while the leaders are beginning to gather strength to get their old highs. That is why this is a cautious stage one. We have leaders, but a mature bullish rally needs more of the markets to participate in passing their old highs. One more thing I'd like to point out is that we can look at the green line above the 2018 price of the S&P, we see upward movement. But on a new high, new low index, we see a slight downtick in this indicator. This is a divergence signal. A healthy market should see both price and the new high, new low line both moving higher. The final chart I want to go over this week is the small cap index. Here we look at the weekly chart of the Russell 2000. Again, I will use the same time frame from the last chart. This index finally got a positive moving crossover the previous week, but the 40-week line is still trending down. Now, this chart, like the previous chart, looks a lot like the 2016 Stage 1 rally. In 2016, the positive crossover happened during weakness in price. But it caught its sea legs and began to rise. And the moving averages stayed in this pattern for more than 2 years. Where are we now? MACD line is green and there is weakness in the moving average crossover. Similar, yes, to 2016. But will it work out exactly like the 2016-2018 bull run? Who knows? The market will dictate that. Just because it looks similar does not mean it will repeat. But I just wanted to show some context of this index struggling while the moving averages cross into a bullish pattern. What does this mean? With the recovery of the S&P complete, we now enter a new stage, stage one of a bullish rally. Now, this does not mean the S&P will rise to the moon. All it means is a new potential long-term bullish run is being attempted. Even though both the S&P and the Nasdaq close at all-time highs, does not mean all stocks, sectors, and markets have participated. In fact, the new HighLow Index demonstrates that there are a small number of stocks that have broken all-time highs, and there is nothing wrong with that. In fact, it is just a process of a new stage one rally. But that number is rising, and that is positive. Now, the key will be, can more markets, sectors, and stocks join the rally and begin challenging their all-time highs? As we saw with the Russell 2000, not all markets have recovered from their loss of 2018. For a mature stage 2 bullish rally, not all markets, sectors, or stocks need to participate, but it will need more than the S&P, Nasdaq, and tech to lead. Stage 1 should always be viewed with a cautious eye. We are currently seeing similar patterns to the recovery and then bull rally after the 2015, early 2016 stock market drop. But just because they look similar does not mean the same results will happen. So no one should think that the same results will occur. It could all fall from here if indices like the Russell can't gain traction to a minimum recover fully from the 2018 drop. Or it could be better, and we could experience a melt-up like the markets experienced in late 1998 to early 2000. The market price action and the demand or lack of demand strength will dictate what will happen. Thank you for viewing my video. Please like and subscribe to my channel for future videos. Also follow me on Twitter at my handle HRSNYC.